Hi, good evening, everyone. Thank you for joining in the call. And as you know, the last few days have been extremely eventful, right? Started with budget, and then we had the tariff announcement, and today we had the monetary policy. So we thought this is an apt time to connect with our partners, right? And like we have said in the invite, this will be a 30-minute call, and we'll try to cover the markets and few of the funds that we recommend at given point of time. So our first speaker for the day is our CIO, Mr. Harshad Patwardhan. Right, Harshad also manages two funds for us himself, which is a business cycle fund and the multi cap fund. Right. So over to you, Harshad.
Thank you, Saurabh. Am I audible?
Yes, you're audible.
Okay. Hi, good evening, everybody. Thank you for joining us today. I want to talk about what lies ahead. But before that, let me spend some time to see how the past 16 months were. To say that the past 16 months, I'm talking about October 24 to Jan 26, to describe them as challenging will be an understatement, right? All of us have lived through this period of anxiety and frustration. If you look at what happened in that period, Nifty was down about 2%. But to see how bad India did, it's important to compare it with other markets. So if you look at MSCI India index in that 16-month period, in dollar terms, because to make it comparable, was down about 13% in dollar terms. Now, contrast that with MSCI World Index, which includes everything, was up 22%. And more importantly, MSCI Emerging Market Index was up 31%. Now, I don't remember in my career this kind of underperformance of Indian equities versus emerging market equities. Generally speaking, I have seen that when emerging markets as a whole, as an asset class does well, India tends to do better most of the times. So it's very unusual what has happened. Now, if I ask as to why has it happened, I can think of three important reasons. One, the EPS progression in this period of 16-18 months has been very muted. So if we use our framework of sources of return, you will realize that over this 16-month period, EPS progressed by only about 5%, which means that there were lots of downgrades to earnings in this period also. And clearly, when Indian market valuations, like always, have been at a premium to emerging markets, because the growth was not there, there was no attraction for foreigners of the Indian market. Second, the most dominant theme, and all of you will agree with me here, the most dominant theme of investment over the last 1-2 years has been artificial intelligence, AI. And Indian market does not have obvious AI plays, like, for example, Taiwan has or Korea has. So India was being dubbed as a contra AI market. So if you are bullish on AI, you don't need to come to India. Third reason clearly was the 50% tariff that was imposed on India middle of last year. And in general, the hostility of US administration towards India. So these are the three reasons why we saw FIIs pretty much abandoning India, even though they were getting enthusiastic about the other emerging markets. Of course, as a result of that, INR also turned out to be one of the worst performing currencies in this period. And when that happens, you basically find the market even less attractive. So that's what has happened. And if you look at the extent of selling by FIIs, in this period, FIIs sold $34 billion in total. And if you only look at secondary markets, they sold $49 billion. So Indian market performance could easily have been even worse. But thanks to all of you and your clients, domestic institutions bought $120 billion in this period. So our performance was obviously below par, but it was not a disaster in absolute sense. The good news now is that each of these three factors that are highlighted seem to be reversing. If you look at EPS growth projections, EPS growth trajectory over the next 2 years is expected to be almost double what we have seen over the last 2 years, closer to mid-teens. So there is a good pickup in EPS growth trajectory. which clearly is a good news. Second, if you look around, clearly there are concerns growing about the massive investment that is going into AI. I'm sure you would have seen announcements by Google and Amazon, the extent of money they are spending. But in general, I think markets are getting spooked by the AI trade. And that actually, in a perverse way, is a good news for India, because India is being dubbed as a contra AI play. So, in a relative sense, let's say compared to Korea, Taiwan, which were phenomenally performing emerging markets, India suddenly starts looking good. And the third, probably the most important one, is the recent announcement about US-India trade deal. I know the deal is not yet signed, but at least the announcement has been made, and that actually lifts a big overhang, sentiment overhang on our markets. I'm sure all of you would have noticed that the currency, behaved very positively to this announcement. There was a big appreciation of rupee against dollar after this announcement. So these are the three reasons I believe that the negatives over the last 16, 18 months that we have seen have started to reverse. In any case, the government policy action, particularly I would say government of India, the fiscal policy action over the last 2 years has been very positive. I'm sure all of you recall in 2025, government took several steps to boost demand. There were tax cuts, income tax cuts in the previous budget. There were GST cuts, very aggressive in October this year. Uh, and of course, there were actions by RBI in terms of reducing rates, but more importantly, reducing regulations on lending. This budget, that was last week's budget, also saw a big improvement in capex, which I thought compared to expectations a month ago was a positive surprise. So the backdrop is looking very good for India investment. Prospects look significantly better. Uh, and therefore, we believe that the relative performance of India versus emerging markets should significantly improve. And we believe that FIIs, which have pretty much abandoned India last 16 odd months, will come back. And when that happens, I think that will be very positive for the markets. By the way, the FIIs as a whole are currently underweight on India. I think from going forward perspective, that's actually a positive, which means that if Indian market starts to do well, there is that much urgency for them to close their shorts. So we believe that the currency will stabilize and the markets will do well. I would like to highlight that we believe at this stage that the market returns, which markets which were flat over the last 18 months, we believe the market returns will be good, but they will likely be front-ended, especially if FIIs come in, in a short span in big quantity. So I think one should position oneself accordingly. So we believe that at this stage, particularly for diversified equity funds, we would recommend investors coming in lump sum rather than long-term STPs. Over the last year and a half, we were saying that long-term STPs is a good way to come in because there were too many uncertainties around. Most of those clouds have lifted, and therefore we believe that lump sum or very short duration STPs is a good way to take exposure to the markets. And I will not be surprised if domestic Indian equities turn out to be a better performing asset class in the next couple of years. I will hand you back to Saurabh.
Thank you, Arshad, and good to hear a very optimistic view about the equity markets going forward. I think it's after a long time that markets are looking very optimistic from here. Thank you for that view. Our next speaker is Parijat Agarwal. He is also our head of fixed income. Parijat will be talking about the budget and the Indian macros. Over to you, Parijat. You're on mute, Parijat.
Thank you, Saurabh, and thank you, Arshad. So Arshad has already highlighted a lot of positives about the domestic economy. So the first about the budget, that what we saw was that the fiscal consolidation, which is extremely important for durable growth, has been maintained. So for this financial year, what we had penciled in 4.4, the government had budgeted would be achieved. And for the next financial year, from the next financial year, the matrix has been changed to debt to GDP. Basically, the idea is that now the fiscal consolidation would happen, but it would be at a slower pace. Now the reason being is that because they've already have kept a target of the debt to GDP of 50% is the target by 2030-31. So every year there will be small consolidation would happen. So for this financial year FY27, the target is 55.6% of the debt to GDP. So that roughly translates to 4.3% the fiscal deficit. So that's a very, very healthy number for our economy that we continue on our fiscal consolidation path, because that adds to a lot of positivity about your sovereign rating, the confidence in the foreign institutional investors about the stability of the macroeconomic picture in the economy, and also the cost of borrowing actually starts to reduce, because if the fiscal deficit is very large, your cost of borrowing shoots up. So that's where and that's very positive for us. Secondly, the capex has been increased again, so it would be something around 12.2 lakh compared to 11.2 lakh crores for the last financial year. So obviously, these are a lot of positives in the budget, although these are not very easily visible, but the higher capex has a multiplier effect on the economy that we have seen. So that's largely a very positive coming out from the macroeconomic picture from the budget. The second and the most important, the picture came in when on Tuesday when the deal was announced between the US and India, and the tariff was reduced from 50% to 18%. The effective date is to be signed. So what exactly it is going to benefit is that the impact on the currency has been very, very tremendous, because if you have seen for the last, I would say, 8 months when the tariff was made 50%, what exactly happened was that the INR continued to depreciate against dollar. But if you notice, it has depreciated much more than the other advanced economic currencies also. Because why it happened? Because the other advanced economic currencies, they had appreciated against the dollar. So what has happened is that we depreciated against dollar, and also to a large extent with other currencies also, against say euro and JPY for just example. So that has had put us in a big trouble, because the inflows had reduced, because when the investors see that the rupee continues to depreciate, obviously their returns are diminished. So obviously they do not want to invest in an economy where currency is not stable and it is depreciating. So with the signing in, the biggest factor has been that the currency would become stable. The inflows should start to come in, because the moment the currency becomes stable and the flow starts to come in, so the investor confidence increases. Now we are already in a much better position, because my currency is already depreciated substantially against other currencies also. So I am starting from a very healthy, or very competitive point compared to the rest of the world, I would say. Second is that when the currency is actually depreciating, what happens is that the central bank continues to intervene to curb the volatility. Now, what happens is that it tends to suck out the rupee liquidity from the banking system. When that happens, the cost of borrowing on the short term goes up. So that's why we have seen that the certificate of deposit rates have gone up substantially. So now the RBI would be much freer in order to manage the volatility or to intervene in the forex market. So as a result, what would happen is that they can uh, provide more durable liquidity to the banking system, which would be very beneficial for the economy. So that's a very healthy sign that has happened, and we could see more flows to come in. When that happens, we could see that our current account and capital account, the deficit, turn towards very manageable levels. That would again bring down my cost of borrowing. So these things when happen, it definitely boosts your growth numbers, because then when the cost of borrowing goes down, obviously it supports the durable growth. So that's a very healthy number. The third is that today's monetary policy committee meeting, where the rates have been maintained status quo, no changes, because anyway, the deal signing has given a lot of push or given comfort to the domestic economy, and RBI would continue to provide sufficient liquidity to the banking system. So overall, the macroeconomic picture looks very, very promising as of now. So although one may say that the RBI has cut the MPC has cut rates by 125 basis points, still the yields have gone up. The reason being the pressure from the external sector that we had seen, and because of the rupee depreciating and RBI intervening, so that should start to fall back to a very, very healthy spreads and level where it will be beneficial for the economy. So overall, it is a very good time for the investors to invest in any asset class, I would say, whether it is equity or fixed income. Fixed income, definitely those institutional investors who are looking to invest in fixed income. Corporate bond looks very attractive, but obviously from the equity aspect, the markets are looking very bright with the improved macroeconomic picture, and it's expected to continue going forward. That's where what we see from the economic point. So that's all on the this front. So what we can look ahead, what has happened is definitely in the last 8 to 9 months, but going forward in this financial year should be very, very attractive for all asset classes. That's what I could think. So over to Saurabh for your
Thanks, Paijat. And yes, so our house view on debt also over a longer period is optimistic. And one, the accruals are high, so it's a good time to lock it into like high accruals in corporate bond and similar other long duration product. Our next speaker is Sanjay Benbalkar. Sanjay is also our head of equity, and I would say last 1 year he has been the man in demand because as I can see, Sanjay, there are multiple questions coming on gold and silver. Sanjay also manages all our hybrid portfolios, including multi-asset portfolio, and he's also managing our oldest fund, which is a flexi cap fund. Over to you, Sanjay.
Hey, thanks, Saurabh. Hello, everybody. In September 24, we launched our multi-asset allocation fund. And at that time, we thought this is a fantastic product to launch because we came with the tagline that choose multi because market kabhi bhi maar sakta hai palti. And though we did not know this beforehand, but in the hindsight, that is what exactly market has done. There are two types of assets in the world: efficiency assets, which derive its worth from the underlying cash flows or earnings, like bonds or equities. And then there are scarcity assets like gold, silver. And when, as Parijat and Harshad highlighted, when there is significant uncertainty in the world, when geopolitical turmoil is happening, when there are tariff barriers are being raised again, then we believe that gold and silver as an asset class are significant asset class, and market has already rewarded them significantly. When we designed this product, we thought of long-term asset allocation from the India retail equity investors perspective, and we thought equity as an asset class has done fantastically well over long period of time, and that's why we allocated significant allocation to equity. And we took to take the benefit of equity taxation, we allocated significant chunk to equity, particularly unhedged equity part. After that, we allocated next allocation to gold and silver. And that's exactly what we have seen in last 1 year, where gold is up almost 85%, and silver, after a significant rally and correction, is still up 150% plus in last 1 year's period of time. And that is something, in my opinion, is a diversification strategy. That is the star of this multi-asset strategy. And that's something which investors should keep in mind. A word of caution that after this strong rally, obviously gold and silver are quite volatile, and that is where we have to be much more cognizant that this volatility needs to be taken into account when people are investing, particularly in the silver as an asset class. But when you are looking from multi-asset allocation, we think that lower correlation between the efficiency asset classes and scarcity asset classes brings the fantastic benefits to investors over a long period of time. And that's why these asset classes should be combined in the portfolio to provide robustness to the portfolio as such. On the debt side, we manage the duration quite dynamically, and debt team has been spearheading that from the dynamic allocation of the duration on the debt part. We believe that in the current construct of geopolitics and the positivity in the equity market, multi-asset allocation funds can be significant allocation from the investor's point of view, and these are evergreen funds to allocate from the long-term perspective. Over to Saurabh.
Thank you, Sanjay, for that quick update on multi-asset. So, partners, like you mentioned in the invite, that we'll be calling each fund manager to come and give an elevator pitch. There are no PowerPoint slides. So they are trying to give you a pitch in 3 to 4 minutes. So each fund manager is managing 3 to 4 funds, but out of that, they are selecting one fund that they think is a fund for next 3 to 4 years. Our next speaker for the day is Prateek Dharmashi. So Prateek, is managing a small cap fund, large cap fund. He's managing the retirement fund and focus fund. Out of the 4 fund, he'll be talking about the small cap fund today. Over to you, Prateek.
Yeah, thank you, Saurabh. Thanks everyone for joining in. I'll run through the philosophy with which we are running the Union Small Cap Fund. Uh, so to just give you a summary or a gist of how we are running it, uh, while we will be going down the market cap to find the small cap ideas, we won't compromise on the quality side. So we won't go down the quality curve while investing in small cap companies. So the foremost focus in running the small cap fund is to identify high quality businesses which demonstrate very strong return ratios as well as characteristics of very high earnings growth. That's where our focus will lie into. Uh, Second would be the focus on corporate governance and the management quality. While running a small cap fund, here the whole focus is to identify the right promoters and good corporate governance practices and back them is the thought process. Separately, we also keep a very close eye on whether the companies are demonstrating the market share gaining or market leadership in the businesses or the industries where they are into. And if that checklist gets a tick, we definitely get into those companies who are either market share gainers or demonstrate market leadership characteristics, are into a duopoly or a monopoly sort of a businesses. We try to focus on identifying and investing into them. If all the three of our parameters get clicked, uh, if the fourth parameter, which is very important to me, is the target addressable market opportunity. So the whole focus is to invest in companies which have a larger TAM, where the opportunity of companies to grow for over 20-25% for a longer period of time is there, is the focus, uh, where the target addressable market is large or their TAM is increasing. Apart from that, we try to identify which are the sunrise or the high growth sectors. We try to identify the sunrise and high growth sectors early and try to invest in to get the benefit of compounding of returns for a longer period of time to create wealth for our investors. So in nutshell, the characteristics of small cap fund would be uh, to have a very long term focus. So we won't be perturbed by short term volatility, which has been a part and parcel of the game, but we will stick out our neck and try to have a very long term focus, buy and hold approach with high focus on quality companies run by good promoters. And the whole portfolio will be built on a high conviction levels. So our active share will be very high in our portfolios. Uh, and the sectors which we are currently very positive on are: one is precision manufacturing, second is power T&D data center side, capital markets, which we all are part of, CDMO, defense, electronic manufacturing, digital and platform based businesses. So these are the 7 themes which we are really, really positive on. And the small cap fund will have maximum exposure covering all these themes, which I believe are the next sunrise sectors in India. Yeah, over to you, Saurabh.
Uh, Thank you, Prateek, for that quick update on the small cap fund. And we have a lot of questions on the small cap recent performance uptick. We'll come back to that later on. And partners, whatever questions you have, you can keep posting it in the Q&A tab, either here or on the YouTube link, right? In the comment section, we will take all the questions after this. Our next speaker is our fund manager, Vinod Malviya. So Vinod is handling our large and mid cap fund, value fund, uh, tax saver fund, ELSS, and a consumption fund. And he also manages the gold ETF and gold fund of fund. Over to you, Vinod.
Yeah, hi everyone. Thank you, Saurabh. So I'll talk about consumption fund. As you're aware that we have just closed a consumption NFO 1 month back, slightly more than 1 month. The reason was very obvious that we are very positive on the overall consumption theme, which we expect in India should ideally do really well. Largely on back of the current macro environment, which is pretty strong outside India, pretty weak on the outside India. And on top of that, there are very good steps which are taken from the government side, which we all are aware that, the GST 2.0, and we're also going to see the 8th pay commission coming in this year, this calendar year. So all these are very good for the overall domestic economy. And given the, the uncertainty which is there in the global economy, most of the economy or countries are going to definitely focus on domestic consumption. And this is where we think India's consumption should really do well in the coming years. And this is where our, the consumption fund will really try to, capture this benefits which are going to say. So in the coming years, we are going to see a very good uptick in the consumption, India's consumption story, and our portfolio itself is will be designed in such a way that we are going to capture the premiumization which is going to happen in India, and also going to capture the the evolving trends and the change in consumption habit which is India is going to see. And through, just to simplify this, how we are going to capture this, we have, come with a framework which we have called as RISE, where, all this alphabet of RISE, that is R stands for rapid, I stands for intermediates, S stands for spend up, and E for experience. I'll just spend 1 minute just to explain what we really try to say, under a RISE framework. So when we talk about RISE, we're talking about R, which is rapid. We are talking about the companies, focusing on improving their penetration. So these are companies where, the penetration itself is today only 10-20%. It could be companies like, operating on the, durable side, or it could be companies on the platform side also, which could be operating on a very underutilization. So they are going to see a very good expansion in the coming years. Second is basically the intermediates. Now, again, intermediates, when we talk about, is basically companies, focusing on, acting as a consumption catalyst. So they would be companies which provide credit, in the form of credit card companies, or normal loans, which could be consumed for a consumption of the overall for the economy. So these are the intermediates which act as a catalyst for the consumption. And the third is basically the spend up or the premiumization story. This is again a bigger part of our overall portfolio. So if you look at the premiumization, which we are talking about, is basically where, the penetration in the particular sector has really reached a certain level. And from incrementally, we will continue to see more and more premiumization. So it could be in the form of, the SUV sales, which we have seen over the, over the last decade. Similar, there are observations in the FMCG side also, and there are many other observations where we can clearly see the premiumization is a way forward, where we will continue to see more and more premiumization playing out in India. And that the last bucket is basically the experience, where we are going to see that as the income level rises, more and more consumption will be spent towards having a better experience. This could be in the form of going for a holiday, or spending, good day holidays on a very good hotels, 3 stars, 5 stars. And that is what we have observed in the last 10 to 15 years, that India's consumption, which used to be a traditional consumption more on the staple side, has evolved towards more on the premiumization. And this is where our RISE framework, which we have developed, will really try to capture and, focus on this. And I'm very happy to also say that, if you look at our portfolio, this is as on 31st January, 60% of our portfolio is focusing on the premiumization, as we had always, talked about during our NFO roadshow. So we are just, going to focus more on the premiumization story, and that is what we are also capturing in our portfolio. In the second biggest bucket for us would be the reach and the intermediates, which are equally currently at around 14 to 15% each, where we are again focusing more on the, companies, sectors, which are acting as a catalyst for consumption side. Our overall, focus would be on the premiumization and intermediates, which would be a bigger part of the overall consumption portfolio. That is all on the consumption side. I would hand it over to Saurabh to continue the session.
Thanks, Vinod. Our next, fund manager speaker for the day is Gaurav Chopra. So Gaurav is managing our innovation and opportunity fund. He's also managing the mid cap fund, the children fund, and active momentum fund. And Gaurav, we have a lot of questions on innovation and active momentum, which I'll take in the Q&A session. So what funds are you trying, are you looking to cover today?
So I will touch upon innovation and some bit on active momentum.
Yeah. Go ahead, Gaurav.
Okay. Hey. We have completed over 2 years since the launch of our innovation fund. I'll just refresh the investment approach and then briefly touch upon the performance angle as well. So the fund is focused on identifying and investing in companies which are expected to grow at least 2x in nominal GDP growth rate over the next 3 to 5 years, and also have some newness factors which is driving that superior growth. The thesis, which is backed by our historical back testing, that companies which have delivered these kind of growth rates have went on to become multi-baggers. And additionally, companies with some newness emanating from various factors have all delivered even superior returns on back of re-rating. We look at 6 buckets primarily to categorize companies in the portfolio: companies which have come out with new products or new services, companies which are using new processes or technology to deliver existing or the legacy products, companies which are leveraged to these new products or services, companies which are entering newer markets or newer customer segments for their existing products, companies which are leveraged to new government policies, and companies which have seen a change in the management of the promoters. Now, some of these companies fall in, say, for example, electric vehicles, e-commerce, CRDMO, CDMO, data centers, power transmission, auto ancillaries, which are benefiting because of this shift in the architecture of EVs. So you'll find all these names, all these themes present in the fund. By doing so, the fund deviates significantly from the benchmark, given many traditional sectors like IT, financials, FMCG, pharma don't qualify to become part of this portfolio, because these traditional names are typically growing in the range of 8 to 10%, or in line with the nominal GDP growth rate, where we are looking at companies which will grow or which are expected to grow at least 2x in nominal GDP growth rate. So just to give some flavor on the themes we are invested in, are the auto ancillary companies, e-commerce companies, digital platform companies, power transmission, data center plays, CRDMO, defense, etc. are the predominant themes which you will find in our innovation fund. Last 1 year performance was impacted, given sort of large caps have outperformed small and mid caps, as well as the fact that sectors like PSU banks, private banks, NBFCs, metals, etc. have delivered far superior returns, which are not present in this fund. Despite this, if you look at 2 year performance, the fund is beating the Nifty 500 benchmark by roughly 2.5% plus. So we remain confident on the strategy, and we remain true to the mandate with no deviation from our stated objectives. We continue to monitor our portfolio growth each quarter, and it has remained in top tier amongst all actively managed strategies, and significantly higher than our stated benchmark of 2x nominal GDP growth rate benchmark. Even in the quarter just went by, the portfolio earnings growth has been north of 25%, both in terms of revenue as well as EBITDA and PAT. So that's on the innovation side. Touching briefly upon active momentum fund. So last 1 year, since the launch of our fund, we have seen very fast sector rotation, which typically gets difficult to capture in any momentum strategy. So if you look at any momentum strategy, it has sort of momentum as a factor has basically underperformed the broader markets, given the fact that there has not been any trend in the market. momentum as a factor needs some trends to catch on to catch a hold on to. For example, uh, even if in a downtrending market, if two or three sectors are doing relatively well on a consistent basis, momentum factor will find its mojo back. So that has been the challenge in last 1 year. But happy to sort of share that if you look at last 2 3 months, there has been some revival in the trends, and which is getting reflected in the improved fund performance as well. So, if the trends do continue, the fund, I have no sort of doubt that fund will sort of significantly outperform the broader markets or the benchmark. That is broadly it. I'll hand it over to Saurabh.
Thanks. We will open the floor for questions. So I have few questions. I'll, point out. I will divide the questions between all of you. Then you can have a look at it. The first question is that the bond markets in India and across the world are not cooling off. Isn't it a risk to equity market if the bond yields are high for too long? So Harshad, can you answer that?
Sure, I will try to answer that. And Parijat, if you want to add, please feel free.
Yeah, I will do that.
Yes. So, clearly, bond markets, 10-year yield on government securities is important from equity market perspective, particularly because that goes into the calculation of, discounted cash flow, which is the, basic way you try to assess the worth of an asset. However, in my experience, what is more important is whether growth is coming back to the market or not. So yes, bond yields being high will be crushing if there is no growth. But if we are going into a period of faster growth acceleration compared to the past, I think that will override higher bond yields. And in addition to that, Parijat did allude to, and I'm sure he will add, is that we believe that with several important crucial things happening now, we believe that the behavior of bonds like currency will also improve going ahead. Parijat, over to you.
Thank you. So what Harshad highlighted is very true, that the growth has to be there. So if you notice that globally the bond yields have increased, obviously because the reason being is that the higher debt issuances, or rather I would say that the central bank or the government across the world have become indebted, and they're borrowing very heavily, right from the US to across to Japan and also India. So obviously, such high levels of borrowing ends crowding out the private investment. But if my growth is much higher, like say for example, if I'm growing at say 10 to 11%, then obviously the impact is much lower. Yes, I could have the equity market could have done much more if the bond yields had been much lower. But obviously, as you continue to grow, and the other factor which is favoring today, and you look at the US markets, that despite their bond yields being so high, they have continued to grow. The factor being increase in productivity. So that is also a factor which adds in the growth numbers. So not definitely the bond yields is a one factor, but there are other variables which are looking quite positive. Like I said, the growth, the productivity, which helps the equity markets to do well.
Can I just add one more thing, Saurabh? Just
Yes, please.
continuation.
Yes, please.
Yes, bond yields is important, but if you look at it in a broader perspective and look around the world, I would say that, and Parijat will probably agree with me, from a macroeconomic fundamentals perspective, in terms of where our fiscal deficit has gone since pandemic, etc. I think India looks like a heaven. If you look at what's happening in US, what's happening in Japan, what's happening in Europe now, which was fiscally very prudent. I think India clearly stands out. So if the external situation improves, I think that will get reflected in the bond market as well.
Very true.
So, Harshad, the second part of the question, which has just come in, was that when the yields are up, the future cash flow discounting also happens at a higher rate. Isn't it negative for the valuation?
No, absolutely. And I think in my answer to the question,
Hmm.
I did allude to that in discounted cash flow, the yield risk-free being high is a negative because it pulls down the value. But
Okay.
in my experience, what tends to override that, if there is a growth acceleration, that
Yes.
will be so. If you look at where the nominal GDP is going, nominal
Hmm.
GDP is expected to accelerate compared to last year, and earnings of corporates are going to accelerate compared to last 2 years. That will override the high level of yields.
Okay. And there are a couple of questions on Harshad, what you spoke about on the market valuations and why it's a good time to start doing lump sum rather than waiting it out. And there are a few questions which have come in, and they just want to recheck. Is it what we are recommending that coming to lump sum right now in equity markets rather than coming for STPs for long period?
Yes, yes. So, let me take all of you back to July, August, September of 2024. I'm not saying that in the context of India, it will happen. Am I audible?
Yeah, you are audible.
Yeah. So I'm not saying that it will exactly happen in India the way it happened in China between July to September, October of 2024. But let me just, spend a minute explaining what happened there. Post-pandemic, because of the restrictions that Chinese government imposed on the level of economic activity, etc., China became probably the most hated market post-pandemic, and till the, I would say, middle of 2024, to the extent that many international investors wondered whether China had become uninvestable. And there was a huge China, by the way, has the biggest weightage in MSCI emerging market, which is the benchmark for most emerging market investors. And investors were positioned in a way that they were very underweight on China, right? Now, middle of 2024, when the policymakers in China started wondering, and in September 2024, in fact, there was a big meeting of policymakers where they essentially said that we will do all it takes to improve the property market. Property market, as you know, was the major factor that had dragged down the economic activity and consumption in China. So when the policymakers said that, just go back and check how the markets did in July, August, September, October 2024. What I'm saying is that India has been probably the most hated market over the last 16 to 18 months. Foreign investors are underweight on China. And as I explained in my opening remarks, many negatives have started to reverse. So I will not be surprised if you see, a repeat on a smaller scale of what happened there. And what happened there is that foreign investors rushed into China. And when the Chinese market started to do well, it became a stampede because your biggest benchmark weight is performing and you are underweight. So something of that sort might happen in India. I'm not saying it will happen, but it might happen. And that is the reason why we are recommending that it's better to do lump sum now because the returns could be front-ended.
Thank you, Arshad. My next question is to Sanjay. Uh, so I'm combining two questions together, Sanjay. Uh, what are the sectors which will get positively impacted with the US tariff deal? And as a fund house, what sectors we are underweight, overweight on broadly?
Sure, sure. No, that's a very pertinent question these days. We believe that there are two fundamental implications of US tariff deal. The sectors which are dependent on the exports to US, I think they will get a fillip in which typically you will get sectors like textile, some of the select chemical names, etc. But we also believe there will be second order impact of this on the overall Indian economy as such, because a lot of capital expenditure, which was supposed to be done by these sectors, was kept on hold, leading to, let's say, lower growth in credit for banks, or some of the companies in these sectors were coming under pressure because of the uncertainty in their business. That uncertainty is now lifted. So we believe that there will be much more broader second order implication of this US tariff deal on other sectors like NBFCs, banking and financial services, even consumer discretionary durables, etc. So these are the two key implications fundamentally we believe are going to be happening from the US tariff deal and also EU tariff deal which has been signed. On the sectors which we are overweight, we believe that given the current construct of the market and the starting valuations of these sectors, we believe that financial sector is something which it's very significantly risk rewarding for the investors over next 12 to 18 months, and that is one sector which we are positive on. Second sector is consumer sector, where Vinod highlighted clearly about how we are thinking about consumer discretionary sector and how premiumization will play out over a period of time, and that is the another sector which we believe is a clear beneficiary over next 12 to 18 months. Another area which we think is now emerging, and we have got glimpses of it in the credit growth in December, and also we are getting to see how companies are talking about new capex wave coming, and we believe that manufacturing or industrial sector is something which will benefit out of it. So these are the three areas which we are quite positive on, and that is how the fund positioning is there across our funds.
Thanks, Sanjay. Uh, the, my next question is to Prateek on the small cap fund. So one of the partners asking that we believe that you have joined in recently, and the small cap performance has turned around and has come in Q1. But if we look at from the inception, the small cap is still lagging. If you can highlight what are the changes you have done in the last 1 year and how do you see small cap going forward? Prateek, are you there on the call?
Yes. Yes, sir. So
Yeah.
yeah, I joined a little over a year back, sometime in December last year. Uh, and I'm very optimistic on small cap as a space currently. It has underperformed meaningfully and for right reasons. So earnings growth, which Harshad has been alluding, was a missing part during last year. We had so just to put numbers in the context, we had almost 1 to 3% growth in revenues or earnings during the same quarter last year, which we are seeing currently as on date. Small caps earnings growth, the PAT growth so far in third quarter has been 38%, which is one of the highest in recent history. Similarly, their operating profit or EBITDA growth is closer to 25% this quarter so far. So good part for all of us is the earnings growth coming back. And that's where I'm really positive with the government initiatives and policy actions that has started to trickle into earnings for the small caps. So my view is very constructive on small caps from here on, and it should do really well after a meaningful time correction as well as a price correction. That's one part of the question which you asked, Saurabh. On the second part, what changes I did? I changed my portfolio in the small cap fund uh, to align with the thought process I am having, looking for India over next decade or next 5 years, where India will evolve, which are the sectors which will really benefit in terms of superior earnings growth, and which are the companies or the promoters who are capable enough to take their companies in that journey. And in that backdrop, as I mentioned earlier during the call, 7, 8 sectors or themes I'm really positive on. Say, for example, precision manufacturing or precision engineering. Those sort of themes were never talked about a decade back. But we have a very capable promoters running many companies which are now evolving and becoming really partner of choice for global partners in the US, Europe, which I have heavily invested in my small cap fund. Apart from CDMO companies or data center, power T&D related companies, um, capital markets I had mentioned, defense. So these are all newer sectors. These are not the sectors which we used to see 10 years back, likes of FMCG, chemicals. So the every decade has newer themes which emerge, and we need to align with those themes or sunrise sectors I've been mentioning at the outset of my call. And that's where my portfolio positioning is heavily tilted towards. And I'm backing those companies and promoters with the positioning as well. And obviously, we will see the volatility in share prices for time and again. But as I told, I have a buy and hold approach where I will weather those storms and will stick with those promoters and companies and back my conviction. Yeah.
Yeah, thanks, Pratik. And the follow-up question, I'll just quickly take the small cap. If you can you talk about the portfolio PAT growth and EPS growth? Any comments on that?
Uh, So broadly, it's again the quarterly numbers are coming through, so that will keep changing. But if I look at our small cap fund and compare it with the benchmark, which is small cap 250, our earnings growth will be anywhere between 1.5 times to 2 times of the index earnings growth, to simplify. So if say for example 15, 18, 20% on an annualized basis is the small cap 250 index growth, our portfolio will have 28, 30% sort of a earnings growth sort of a portfolio.
Thanks, Pratik. So I'll move on to Vinod. There's a question on consumption that the entire consumption story is heavily dependent on private capex growing. We are not seeing signs of private capex growing. What's your view, and how do you see in next 3 to 5 years will private capex pick up in India? Vinod, are you there on the call?
Yeah, I'll start. And I'll also ask Harshad and Sanjay if they want to talk about the private capex side. So, definitely, as we speak, there are, when we look at a larger picture, things are not really looking good. But, there are pockets where we can definitely find good ideas or consumption is really doing. Just to highlight one sector is definitely the auto space, which is doing really well. And similarly, there are, other sectors, consumer durables, which is also doing reasonably well, as of now. Regarding the commentary also, which we have been hearing from the company side is that, when we look at commentaries coming from, State Bank of India or L&T, they're also indicating that private capex was relatively much weak over the last 1 years, but there are some initial signs that it's gradually picking up. So we are very confident that as we go forward, the steps which has been taken by the government on the GST 2.0 plus the tax benefit which has come for the individuals up to 12 lakh rupees and the upcoming this 8th pay commission, all this will definitely ensure that the consumption, which has been pretty weak over the last 1 or 2 years, should ideally pick up. I would just request anyone else if you want to add anything on the consumption side.
Yeah, maybe I'll just add a couple of comments over here.
Yes, Sanjay, go on.
Yeah, thanks. So as Vinod highlighted, see there are multiple levers to consumption, and as if you look at the longer picture for India, as India's per capita income is growing, that is clearly going to benefit consumption story as such. On the capex particularly, we are seeing multiple green shoots in capex. We have seen banking level credit growth itself picking up from 12% in the middle of December to almost 14.5 by the end of the December. We have seen multiple announcements coming from now the sectors may be changing, particularly if you look at data center and semiconductors. We have seen a plethora of announcements, including global giants like Google, Amazon, Microsoft announcing multi-billion dollars of capex in data centers and semiconductor space in India. If you look at auto side as well, today only one of the large corporate giant has announced to increase their capacity by 50%. If you look at power T&D side, there has been a continuous news flow coming that demand is outpacing supply, not only India but globally as well. And these are signs which are giving us idea that capex is actually starting in India. It is just a matter of time; it will show up broadly on in multiple sectors. However, in consumption, particularly when you look at the RISE framework, where we are focusing on reach, intermediates, even the premiumization story, spend up, and experiences, we believe that that framework captures the overall consumption story of India, and that is something which we are focused on.
Saurabh, can I
Thanks,
just
Sanjay.
add?
Yeah,
Can I
please
just
go on,
add
Harshad.
to the
Yes.
what Vinod and Sanjay said? So couple of things. One is the observation of the questioner is right, that for the whole consumption to become a sustainable virtuous cycle, private capex is important. And as both Vinod and Sanjay highlighted, there are signs that private capex is picking up. Apart from that data being there in the on the credit numbers, multiple capital good companies which cater to multiple segments, the likes of L&T, the likes of Cummins, ABB, etc. Their commentary also suggests that investment had started happening in the Indian, Indian context. I will just also highlight an important sector. After the FTA signed with Europe and also the duty reduction in US, we believe that textiles is another sector which should see, logically speaking, a lot of capex. And by the way, that is one sector which is very employment intensive. So that should lead to incomes growing. In addition to that, we have seen that tourism as a sector has done well in India. And that is one sector which is again manpower intensive. So I think these developments bode well for the consumption story to become sustainable.
Thanks, Harshad. The next question is for Gaurav on the innovation fund. So the question is, while in 2 years the fund is in quartile 1 compared to peer group, in last 1 year the performance of the fund has slipped compared to the other innovation fund, right? Are you looking at course correction, or if you can describe more on how this fund will behave over a longer period compared to other innovation funds in the market?
Sure. So if you look at other peer, so the primary reason the fund has not done well because uh, within small cap, mid cap, and large cap indices, the sectors which did well uh, are are not present in our innovation fund because of the reasons I've already highlighted, that we're running the portfolio with an approach that if you hold these companies, these stocks for 3 to 5 years, these companies should deliver outsized return. There will be periods like this where this fund will not be able to participate. Uh, some of the peer funds, if you look at the portfolios, people sort of do have companies which fall into these segments like financials or IT or PSU banks or private banks per se. So from that perspective, the performance differences will be there compared to that of our innovation fund. We are not sort of changing the style. See, what we are concerned, so we should be concerned about if a company in my portfolio is not growing at 20% sort of CAGR in terms of profits, then that is the worrisome sign. If that is happening, then we are holding on to the bet, keeping in mind that if you hold this company for 3 to 5 years, this company with the portfolio will end up outperforming the benchmark. So we're not changing or course correcting that objective. Obviously, the additions or deletions are with respect to stock specific concerns on the growth side rather than short-term underperformance compared to the peer set or the benchmark.
Yeah, and Gaurav, I would like to add something, and you can correct me
Sure.
or add anything. So what you must also look at in a category like innovation is how much is the active share compared to benchmark. So if you look at the benchmark is a broad benchmark. It can be Nifty 500 or BSE 500. And we are running an active share of 92%. So typically the usual suspects, the top 10 names, we are zero over there because they don't fit either in the innovation category or the opportunity category, and certainly not in the high growth companies, right? So when you're taking a portfolio like this, it's a unique portfolio compared to all the other funds in the market, whether innovation or other categories also. And typically these portfolios are meant to give performance over 3 to 5 years. So if you look at 2 years, the fund is in quartile 1. Last 1 year, other sectors which are not part of our funds have been working. That's why the fund underperformed. But we are confident it's a good fund to have for 3 to 5 years and can be an outperformer fund from our fund house. And Gaurav, since you are here with me, there are multiple questions on momentum fund. I'll all combine them in one. And if you are okay, I will try answering them, what we have spoken about multiple times over the last few months, and you can add on to that.
Sure.
So the question is more on the underperformance of momentum fund. So there are many questions on that, underperformance. So yes, we got the timing wrong for the momentum because we launched in December, and after that, the momentum strategy has not really worked in the marketplace. So the timing was not the best of timing, and unfortunately, that's the only fund where we got the timing wrong. Otherwise, all the other funds we were able to get the timing right. Right now, the questions are compared to peer group, the fund underperformed. Yes. So what you should realize is that every momentum fund is built on a specific quant model, right? And two funds in the same momentum space can work very differently because the quant models can be very differently. If I look at 3 months back, the underperformance was huge. In last 3 months, our performance has come back very sharply. It has covered up some of the underperformance of even last 1 year. So the closest peer group gap has got narrowed by 9%, right? So that gap was very wide. It has got covered for 1 year by 9%, right? Which is quite a significant cover in 3 months, or like 1 year return coverage of 9%, right? Compared to peer group, the closest peer launched at the same time. Now, every momentum fund will have its day under the sun if the right model is built right. We are confident that our quant model is built right and will perform in the coming 3 to 5 years. In fact, if you look at our equity view, we are extremely positive on the equity going forward. From here, we think the valuations are, fairly priced and the earning growth are coming in. Now, if you are looking at a rally coming in, there's a high chance that momentum as a strategy also will work extremely well in times to come, right? And when that starts happening, it also covers up the previous losses. And when we showed the back-tested model, it was exactly the same. There were periods when the funds underperformed significantly, but when it came back very sharply. We are confident that will be the outcome which is going to happen in next, few months or 1 or 2 years as the market rallies. You need to have patience with the fund. And I think if you're coming in a momentum fund, 3 to 5 years is what we should look at bare minimum. Gaurav, if you want to add anything on this.
Yeah, no, Saurabh, you covered it well. I'll just sort of just to sort of refresh. See, momentum as a factor in last 1 year has not worked in the market. So if you look at Nifty Momentum 50 TRI index return, it is flat on a 1 year basis. At the same time, Nifty 500 TRI index has delivered 9% return. So it's a 9% underperformance by the momentum factor itself. Even if you look at the category median of the sort of momentum strategy, it is something -1% roundabout. So the underperformance is roughly 10%. So the factor has not worked in the market in last 1 year. Just to sort of refresh, starting universe
Right.
in our momentum fund is top 1,000 companies free float in terms of free float market cap. Some of the peers do run it on top 500, top 400 stocks as well. One needs to keep in mind the sharp divergence in the performance of large cap, mid cap, small cap as well in last 12 months, where small caps have delivered 1% return, while large caps have delivered 10% return. So the starting universe is also different with respect to our momentum fund compared to others.
Thanks, Gaurav. I move back to Sanjay. Sanjay, we have multiple questions on the view on gold and silver. So I will cover 3, 4 questions in one, and then probably you can, elaborate on that. Prashant, can you get Sanjay on the screen, please? So the question is that one, obviously, what's our view on gold and silver going forward? Then one of the partner have asked that our multi-asset fund has delivered a return of 24% in last 1 year, ranked number 3 in the category of equity taxation. How do you see next 1 year for the fund, right? And do you still hold significant position in gold and silver? Then one question is, do you keep changing gold and silver dynamically? Right? Are you doing an active allocation in gold and silver, changing the percentage exposure? So over to you, Sanjay.
Sure, sure. So when we launched our product, we were designing the product and we did good amount of back testing with respect to our product as well. And what we realized is that gold and silver is a significant asset class and makes significant sense for Indian investors to have a larger allocation in terms of gold and silver. So when we designed the product, we allocated a significant portion, almost 65% to equities, but the next highest allocation of almost 23% went to gold and silver. And that view continues, that we believe that in the current geopolitical uncertainties, in the current tariff related uncertainties which are ongoing in the world, whereas and also a lot of wars are being talked about, we believe that gold and silver as an asset class is a fantastic asset class for investors. We also talked about how currency related volatility is beneficial to gold and silver. If currency, particularly Indian currency in this context, depreciate, that also contributes, it acts as a hedge for currency, and that we have seen playing out in last 1 year's period of time. So our view on gold is quite structural and quite constructive. We believe that gold as an asset class is fantastic asset class for investors to own. Silver for us is a more of a tactical bet. We, as the question is requesting, we have been managing that bet very dynamically. So just to give you a brief, till almost April, we had almost negligible allocation to silver. By May and June, we had almost 10% allocation allocated to silver in our multi-asset allocation strategy. So it's very tactical call, and we manage it very dynamically. We have booked significant profits, and currently we are sitting somewhere around 3 to 4% in silver. So the call on silver is cautious, that we have been cautious on silver, but gold is structural and strategic in nature, and we will continue to have significant allocation. So 20% plus kind of allocation to gold and silver. Next 1 year, I believe that equity as an asset class will do fantastically well, and that is where more work is going on to allocate higher allocation in unhedged equity part, particularly finding bottom-up ideas in the mid-cap and small-cap part as well. And that is the work which I have been doing on the multi-asset strategy, that increasing allocation in mid-cap and small-cap as the time is progressing, as the results are coming, as we are finding bottom-up ideas, and that is the work which is being done. At the same time, gold is now still a dominant asset class in the bullions part. That is gold and silver. Dominant part is into gold.
And do you see a repeat of 24% in next 1 year?
So last 1 year's rally in gold and silver was actually quite parabolic. Whether that will repeat or not, I'm not sure. I'm looking at more from the diversification point of view, how gold and silver as an asset class are divergent than equity. Our constructive view on equity is getting reflected through higher allocation in equity. Whether that will repeat FY 24-25 or not, that needs to be seen.
Okay. Thanks, Sanjay. And our next question, Sanjay, I'm throwing to you only. That from Union Mutual Fund, if we have to pick up 3 funds for SIP, and since you're heading equity, right, what 3 funds would you recommend for SIP? It's a long-term SIP, right?
So we are becoming quite constructive on equity markets, and we believe that current equity starting valuations are also quite attractive from the risk reward perspective. We believe that from the lump sum perspective, we already talked about how flexi-cap, multi-cap, or multi-asset become go-to areas for any investor to take immediate positions in the equity market and increase allocations in the Indian equities. However, if somebody is looking at pure SIP part, we believe that our mid-cap, small-cap, innovation and opportunities fund, these are the fantastic funds to start SIP and continue for a longer period of time as well.
Thanks, Sanjay. Harshad, can I ask you the next question, please?
Yeah, sure.
So Harshad, the question is on business cycle fund. Are there any changes done on the business cycle fund recently in terms of strategy, and how are you looking to manage that fund in the future?
So that fund is meant to be a fund where we take fairly aggressive bets on certain sectors or themes, and significant underweights on themes that we don't like at a point in time. So that sort of purpose of business cycle remains. What I would imagine will happen in the future is that with better clarity coming in, as we know that last year and a half was a period of uncertainty, and we don't know which way things are headed. Now that there is more clarity, you would see that more pronounced in terms of big overweights and big underweights in certain sectors. So that is how I am looking at this fund on a going forward basis. So the theme remains the same. It will become more pronounced because now the layers of uncertainty are lower than before.
Yeah, so the follow-up question for you specifically. What are the headwinds you are seeing in the market for next 1 year? Right? And and you've already answered it. From a medium-term perspective, how do you see the market? So, like we have said twice, that we are bullish on the market and the current
Yes,
valuation. But if you can take about headwinds, possible headwinds in the market for next 1 year, the risk
sure.
you are seeing.
So, clearly, so long as the current occupant of White House stays, there is always an element of uncertainty. We don't know what's going to happen next, right? So that trepidation is always there when we come to the office in the morning and switch on the Bloomberg. So global uncertainty, volatility is here to stay for quite some time. So that is a broader level headwind. But in the in the Indian context, I would like to highlight that supply of equity continues to be a big headwind for the secondary markets. We have seen this play out over the last several years, more pronounced. What I mean by that is the IPOs coming in. And, I didn't mention that number, but, let me talk about that number. I talked about the FII selling $34 billion, $49 billion in secondary market, $120 billion of buying by DIIs. What I did mention was the supply of equity in that 16-month period was $87 billion, of which only $52 billion was growth capital, which means the company raised by the companies to use for capex or otherwise. But there was an increase of $34 billion in free float in terms of OFS, in terms of private promoter selling, etc. I would say that that will be an overhang in the market, and which is another reason to say that the returns could be front-ended, because when the market starts to do very well, you can be assured that there will be a spate of IPOs, a spate of supply that will hit. So this, in my opinion, is the overhang.
Thanks. So I've covered all the questions on the webinar link. Asha, we have any questions on the YouTube link?
I can't see anything on YouTube link, sorry.
Okay. So guys, thank you everyone for joining in, partners, and from Union Mutual Fund, what we are focusing on given the current market valuation, the product you should be looking at from our side, from our recommendation. Clearly on the thematic side, we are extremely bullish on consumption and innovation fund, both of them. And we believe that both the themes will play out over 3 to 5 years. If you look at a broader equity funds, what are we looking at right now? So clearly we are looking at a flexi and multi-cap depending on your client's choice, where he wants to come in, and especially the small cap fund in the mainline fund. In terms of the hybrid, yeah, multi-asset, we got the timing right, and the fund has been doing extremely well, and Sanjay has been very nimble-footed in managing that fund. We continue to recommend that fund for the people who are slightly want an allocation product, a risk-adjusted product over there. And Sanjay and Harshad, if you want to add anything which I missed out on the product, and by the way, there have been two feedback that this is a great initiative by Union Mutual Fund, getting all the fund managers together. And one of the distributors has said that it gives a lot of confidence in Union Mutual Fund. And the request is that if you can do it in regular basis in the similar format, which is without a PPT, and getting everyone together and doing an elevator pitch on the market and the funds we are looking to recommend. So anything, Harsha, Sanjay, I missed out on the fund recommendation from our side, you can add on.
No, I think Saurabh, you covered it well. And I would also like to thank all our distribution partners for giving us this opportunity, and we will definitely try to make it periodic.
Yeah, thank you everyone, and thank you everyone for joining in the call. Thanks.
Thank you.